Okay, hi, hello everyone. So as promised, I'm gonna try to get this video out to you as short duration as I can, but yet I'm not gonna compromise on the understanding of the video. So I'm gonna try to explain as best as I can for you, and we'll go from there. Okay. So first of all, let's start with the what each one of these means, and we can go with that, and then I will get into Thinkorswim and explain in further details. But what is a cash secured puts? Basically, what it is you are selling. Remember, not buying, selling. You selling a put out of the money, at the money, even in the money, depending on your direction bias. Okay. Now, why does it say cash secured? The reason why is your broker wants you to have enough money just in case you get assigned the shares, that you have enough money to fulfill it. Okay. So say each contract is 100 shares. You sell a put, you got assigned because it's in the money now. You now have 100 shares. 100 shares, say, of Apple, okay, at the current price now is what, $115. So you need, I don't know, 11,500 bucks, right? So if you don't have that money there, your broker will liquidate it on Monday. They will sell your position and liquidate it. But if you want to prevent that from happening, because you don't want to take a big loss, you say, hey, I'm going to do, now that I got a sign, I'm going to do a covered call. Okay? Covered call, right? So you want to do a covered call so you can go ahead and make that money back. You simply, on that weekend, you either call your broker. Unfortunately, I'm sorry if you have Robinhood, because Lord knows when you do a free platform, you're not gonna get any tech support or any support whatsoever. So there's no phone call because they're not gonna pay anybody. They're not making money. Well, they are, but that's besides the point. You email your broker, say, hey, please don't sell, don't liquidate my position. I am sending money in as we speak. But remember, your broker don't get the full funds for a few days. So, but as long as they see the transfer in there, they won't liquidate your position. Okay. Unfortunately, the bad thing is you may incur some margin interest. I don't know. Find out with your broker. It hasn't happened to me because I don't need to have that, because I have the cash secured to do these, so I'm okay. But for you guys, you might need it, and if you need it, you just need to call your broker. Okay. With that said, that's exactly what a cash secured put is. Okay. So you sell puts, but you have to have the cash to secure your puts. That's all it means. What is a covered call? A covered call simply means that you own shares and you selling again, as I mentioned, selling calls to cover your position. That's what a covered call is. You're covering your position in case of further downturn. Unfortunately, when you sell option, as I mentioned before, you can only, the max you can make is what you receive or what you see on the premium. Okay, that's your max. That's all you can make. So you're not fully hedging your position, right? So if a stock keep on going down, your option can become zero. And that's all it is, just zero. And you're done. You make your max. So you cannot protect any more than that. So that's what a covered calls is you just covering. What is a married put? A married put is the reverse of it, except you're basically having 100 shares, and you're long a put, buying a put to protect the downturn. Now here's the bad part: is if you buy an out of the money put, and if stocks range or if stock stays the same, your put will decay and you will not make money, you actually lose money. Remember that, decay. Theta is going to kill your premium when you long or when you're an option buyer. That's why a lot of people are option seller. When you're an option buyer, the decay or the theta will basically eat you alive. So when you do a Mary put, you want to do at the money, in the money, and hope that it actually does drop, okay? So that you can recuperate or prevent your loss. So a Mary put is not an income strategy per se, but more or less a Mary put is it's a hedge position. Okay? Now, when you put a covered call and a Mary put together, you get a protective collar. So basically, it's a covered call. You have long shares, a short call, and you buy a put to protect the downside. Okay? Because why? Remember what I say. When you're option seller, the most you can make is what you receive in premium. Right? With a put together, you can make further and protect 100% of your option. So say for instance, you have 100 shares of Apple and your short call is at a 50 delta. Now you just need to buy a put that is 50 delta to make it 100, because delta is the price movement of option versus for each dollar the stock move, right? So now you can protect it 100% by going 50 delta on the other side and let it go down. Okay, so basically that's a protective collar. It's the covered call and the Mary put together, and it's a protective collar. Now, what's a poor man covered call? Simple. You buy a leap. And I'm going to get into this with Thinkorswim in a second. You buy a leap. A leap is just simply another term for a further expiration date option. So, in my definition, it's 6 months or more. Okay, that's what I feel that's a leap. Okay, it's 6 months or more option. So right now we're in what, September? You can buy a February, March of next year. That's a leap. Just think of it as you're leaping further, okay, to buy option. Okay, and so that's pretty much it. Now I'll get into it. And a lot of you guys say, "Oh, what is a leap? What is a leap?" Think of it as a long-term option or long-term equity anticipation securities, right? That's what I call leaps is. Long-term equity anticipation securities. So you're buying way out expiration, anticipating what is gonna move. Basically it. So now that you understand a little bit of those, let's get into Thinkorswim. I'll show you exactly what we're doing. Okay, so right now we have, here we go. We are in virtual mode again, and we're gonna get this thing going. We're gonna just do Apple, make it easy, right? Apple right now is 318. We're gonna do a cash secured put. Okay, and I do weekly, you can do monthly. Remember again, let me just say, monthly option expiration is the third Friday of every month. Third Friday of every month. You see that? These are all monthlies. Weekly, you will see weekly, okay? So I'm going to do a weekly. I'm going to do a cash secured put. I say, Apple, right now we're in June 1st. Okay, I went backward because just make it easy. I say, okay, I don't think Tesla's going to go down. Apple is going to go down. We're in Apple. I don't think it's going to drop below. I can even be risky and say, hey, I think my direction bias for this week, I think it's going to go up. By Friday, I think it's going to be $330. So I'm going to take a risk. If it's below $320, guess what? I'm going to get assigned, right? But if not, I'm going to make money. And a lot of institutions, a lot of pro traders, they can see, if they project it, right, that Apple's going to be at a certain price, they're going to say, hey, I'm going to sell deep in the money puts. I think the next support, the next resistance for Apple is at $330. Now I don't remember what Apple on June 1st is, unfortunately. So I'm just gonna give you an example right now, okay? Just to make this example even clearer. Let's say I'm willing to buy Apple at 330. Okay? If I'm in the money at that time, that means that I'm projecting ahead, or else right now Apple's only at 318, 319. That means I'm gonna buy Apple, if I get a sign, at $10 more. However, in my projection, I say, okay, Apple's very bullish right now. I'm gonna sell Apple at 330. What the heck, right? Oh, I'm in. So I just sold Apple at 330. I don't know what's gonna be like, but I know that if Apple is above, I'm gonna make $1,145. If not, I own Apple. I'm gonna exercise. I'm gonna get assigned Apple at $330. So if it dropped 320, this is why when you buy deep in the money, it's a risk reward situation. A lot of people don't do it. A lot of people would do this. They would do out of the money. Okay? When you sell option, a good rule of thumb is under 30-day delta. Really safe. I usually do 16 delta just to be even safer. Okay? But under 30 is still safe. But if you're very directional bias, if you know for a fact that you looked at the chart and you say, hey, you know what, Apple's going to be at 340 by the end of the week, you can do deep in the money. And guess what? You're going to make money, really good money. Because remember what I said? Out of the money, in the money, anything out of the money expires worthless, right? And look at this. And remember this, when you option seller, the most you can make is this amount here. Okay? So they have a bid and an ask. Usually I'll try to do it right in the middle, and you can get filled right in the middle. At least get you extra few dollars when you're selling options. Okay? So you can do a 305. You can do a 310 because these are pretty safe. This is a 21 delta right now. Right? So you can sell this put 21 delta, and if as long as Apple does not reach below 110, I'll make this full amount. But we just did this, so let's see what happens, okay? So we're gonna forward it to the 5th. Cross my fingers. Well, it plays out. Let's see what happens. Hey, look at that. Apple's actually at 326. We're at 330. And we're on Friday. Right? The unfortunate part is if Apple does not get above 330 at expiration, we are going to get the share. $330. But the good part is, look, you made this money. So even if you get 330, you're going to make the money. Well, let's see. You're going to make this money. And you own the shares? Fantastic. But if it doesn't get to sorry guys. I'm going to forward it to almost closing time. Now remember, keep in mind I'm in Pacific time. So my time is trading hours is 6:30 to 1. Okay? So look at that. Oh, wow. Apple's at 331. So guess what? At expiration, if it does expire above 330, I get to keep this whole amount, guys. No shares, no assignment, it'll be 0. And here's the deal. I'm going to close this out right now. Look at this. Only 7 cents left. I'm not going to wait. The reason why is It's only $1.30 right now. Apple can drop, right? Right at closing, it can drop $1.30. Then I'm in the money. I already made $1,300. I'm gonna close it. Okay. Remember, just close it out, guys. Please. Close. Done. I just profit $1,138. I'll do it again, right? So now I can look. Now I can look into June 19th. Now that I close that out, and do another put. And this time I say, you know what? Apple have jumped so much. Look at that. Look, it's dropping. See that? That's why you want to close it. You don't want to take chances. God, you made already the money, right? So even at 50, 60%, close it. You're done. You made your money. Move on. Okay? So here's the deal. I'm going to say, okay, now June 19th. I think Apple's going to range. I don't know. I'm not looking at any chart, but you can do this. You can buy right at the money or even out of the money, right? To be safe, you already made 11. I'm going to do this one. I'm going to sell this one. I'm in for next week. So now it's rinse, repeat. Rinse, repeat, right? And we're going to keep on doing it. So say, for instance, this one here that we just got into, Apple actually dropped. Just for example, at 320, okay? So let's say Apple dropped to 320. Let's get out of here. Let's close this one. Come on, close it up. Okay. Just to make things faster, I'm going to do market. Okay. So, say for instance, Apple is at 320. So, in order to get us to 320, we're going to go backward, okay? Okay. So, we're going to go back to the first. Say you bought June 19th at 320 and actually Apple dropped and now you got assigned. Okay? I'm gonna go ahead and go here, buy 100 shares, done. Okay? I am in at 320.03. Now we got assigned, we're gonna do the wheel. Now we're gonna do covered call. Okay? I'm gonna show you covered call. We're gonna go here. Now we're gonna look, you can do weekly or monthly. Okay, again, that's your preference. For newbies, I recommend monthly. Here is a little secret if you have Thinkorswim. Unfortunately, on demand doesn't have it. But when you're trading on a normal platform, real time, if you look over, you see all these are we call this your option chain. Okay, if you look to the right, all right here, you will see the expected move of Apple or each expiration. So you say, for instance, June 19th, you will see right here plus or minus $20. Okay, just an example. Okay, so if that said, June 19th, they expect Apple to move around $20. Then you can say, okay, I'm going to play around 20, give or take. So I'm going to do $25. Okay, so I'm going to, now that I own 100 shares of Apple and the expected move around 20, I'm going to add about maybe $5 to $10 extra dollars. I'm going to say, okay, that's $330, right? That I can sell Apple. And I can do that. Now, let me just kind of explain a little bit here. I'm going to pause this real quick. Keep this in mind. If you're buying a covered call from scratch, that means zero loss on your shares. You don't have a position in it. I would recommend the best thing to do is do at the money. Okay, this is at the money, guys. 320. I'm gonna buy a covered call. You just click here, go to cover stock, and 320 right around here, you buy. You'll see it. 100 shares and sell one contract right there. Okay, debit. So reason why I say that, if you have already in a position that you're losing money, right? You're currently losing money on your stock. Say Apple, you purchased 320, it dipped whatever, and now you're losing 1,000. You do not want to buy or sell a call at the money, because then you lose more money when it goes up, right? You gain some back, but yet you did not gaining enough back, but yet you got a sign on the option, and now your stock gets taken away. So you're actually losing money. So it's kind of like a stop loss, but you didn't want to lose your shares yet because you're still trying to make money back. So I would say, if you are in your position already, sell an out of the money call right around here and slowly gain that money back. Remember that. You anticipate the move. Remember what I said about over here? You will see an expected move from Apple for this expiration. If it said $20, 320 plus $20, that's 340. I'm going to sell it one right here. They expect Apple to move either 20 up or 20 down, right? If it's 20 down, you're going to make money completely on this one. If it drops, you'll probably make 50% in a day or two if it drops, right? So then you get rid of that one and sell one that's closer up here, right? Because now stock's at 310. You don't want to keep this anymore. You want to get rid of it because you made profit. Now you're just going to go roll it down to 330, and you're going to make more money, okay? And waiting for Apple to go back up, right? But you don't want Apple to go 330 when you own the stock at 340, because then you lose $10 here, right? The difference. But yet you got a sign on this, so your share's gone. So you still lose money. So remember that. You want to sell out of the money if you are already in the stock position and losing, depending how much you're losing. But I'm just telling you that now, okay? But if you're doing a covered call from scratch, then that cover stock, boom, then you want to do it at the money or slightly above, and you'll be good, okay? That way you make money. So I'm going to play this. Right now I own 320. I'm going to do 325. I'm going to click this, sell one. Boom, boom. Wait, this is June 19th. I'm in already. Okay. So I didn't want to do June 19th. I wanted to do... Let's just get rid of this one real quick. Sorry. For training purposes or teaching purposes, I want to get it closer so that we can get this June 1st. So I'm going to do a cover call at 325. Okay. Okay, I'm in. So now I got 100 shares. Remember, one contract equal 100 shares. So you want to have this equal. Okay. If you have 500 shares, you want 5 contracts. That's 500 shares. 500 and 500, negative, positive, cancel each other out. When you sell, remember, sell option is a negative. When you have long stock, is a positive. Think about it. Just in math and when we, biology, when you have a positive, negative ions, so it will cancel each other out, right? So if you have 1,000 shares, you need 10 contracts. It's 1,000 contract or 1,000 shares, and those will cancel each other out. Now let's go forward to June 5th at 12:52. It's okay, just whatever. Okay, so let's see what happens, right? Look at this. I made $1,000 here, guys. But I'm losing money because I'm in the money on 325. So guess what happened at expiration? At expiration, I'm gonna get assigned this call. But I made 1,000 here. But here's the good part, right? That's why I say you have to understand where you're going. if you start from scratch, just pretend that I just started from scratch, both together. I did the covered call together. I automatically made really, really good money. Look at this. Okay. I'm gonna pause this because this is about to expire. This is 325. I'm gonna lose 325, 322 here at expiration. However, get this, you receive this as credit. You're gonna keep this amount right here. Okay? You're gonna make this here. So let's do the math. Right? You wanna do the math? Just pretend right now is expiration. Ding 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 ding, right? 1023. I'm gonna minus 322. I made 701, but I also get to keep this credit. So I just made $909, right? When this expires. Isn't that cool? And if I do this week over week over week over week, guess what happens? Now you got to be directional, you got to know exactly where to place that short call. Right? The reason why I made this money because Apple went up crazy. Look at that. Because I was in at 320, it's already up 330, so that's $10 at 100 shares. That's $1,000. But because I lost here and I gained back here. Right? So you made money, really good money. So imagine you keep on doing this. You sell the put, you get a sign on the put, you do the cash covered call. It's a wheel strategy, what we call it. You don't even have to do the put. Right? You can just do this straight up. Now, here's the best part. Okay? You have these two. Now say for instance it was last week and the market's gonna tank. You buy a put, in the money put. Okay, look at this, 325 June 5th. Okay, right now it's at, the delta is 95 delta, but because it popped up so high. But look, now you become a protective caller, right? By buying a put. Say for instance you're expecting the stock to crash on bad news and you saw that, boom, you jump in and you buy a put. Okay, now you have a protected caller, because keep in mind the short put can only make you so much money. Remember that what I said? You can only make, let's do this one, you can only make this is your premium, but that's the maximum amount you can make depending on what strike it is. Okay, that's your max. Selling calls, that it relies on theta, so this is what your max profit is. But if you buy a put and you know that the market's going to tank, you buy a put to protect it. It's called protected caller. Now you got, the short call is to go down, the put is also to go down, the stock to go down, right? Remember, when you sell call, when you buy call, you expect the stock to go up, but when you sell a call, it's the reverse. Same thing with the puts. If you buy a put, you expect the stock to go down, but when you sell a put, you expect the stock to stay still or go up, right? So the reason why I say stay still is theta. Eventually, if you buy 330 and it never changes, well, guess what? This will come to zero. You make the money, right? Because it's theta. Because you want this to go down. So again, that's what you call a protected put. That's a very simple, nothing much more than that. I'm sorry, it's a protected caller. So you just add, with a covered call, you just add a put. I would recommend somewhere at the money or in the money. Remember what I said about last week about 85 delta? Why 85 delta? Say you just have long stock. Long stock move dollar for dollar, right? 85 delta to move 85 cents per dollar. But when it keep on dropping, or at least drop a little bit, you still make money because the 85 delta can become a dollar or 100 delta, right? And if the stock go up, your put decay a little bit or go up a little bit, so you can exit. But if you buy out of the money put, guess what? It decays. You may end up with zero. So at least you have some value here left, because you have the delta. And not only that, stock don't go one direction, guys. It goes up or down every single day. Okay, so now here's another great strategy, and a lot of people do it. Why? They call this a poor man covered call. Okay, a poor man covered call is simply put 6 months. Leaps for me is 6 months. Okay, that's just my. You can be anything as far, some people think, as long as it's further out, it's leaps. That's fine. You're okay. For me, I just think it's 6 months. So let's say January, just because we're close to it anyway. So, or even June. Okay, I think June would be a good leaps. Look at this. Remember, always, please, when you do a poor man cover calls, please. I'll explain in a second. Always buy at the money. Don't buy out of the money leaps. Okay? Reason being is when you're out of the money, you cannot exercise your option. Right? So if you sell weekly calls, remember, poor man cover calls and covered calls is exactly the same philosophy. The only difference is you're owning another option chain. That's it. Instead of owning stock, you're owning options, right? But since you already have stock, if you get assigned the option assignment, you get shares once you get assigned. And those shares, negative shares, and you have long shares, it washes each other out. However, with leaps, if you're out of the money, you can't exercise your leaps to cover your short. So if you have a short, a short call, if you have a short call and you bought it at 340, right? And you bought your leaps at 400. Well, guess what? You cannot assign this to cover that other one. So now you end up eating the negative. You just lost money. Because now you bought a 340 calls and Apple went up to 360. Now you lost. Now you have a huge negative on here, right? But because your leaps is 400, you can't assign that. You can't exercise that. You want to exercise because why? When this becomes 360 and you get expire, you have 100 shares of short. Right? A short, remember, is reverse. When you have a call, if you get assigned a long call, you get long stock. If you get assigned short call, you get short stock. The reverse on the put is if you have short put, you get assigned shares because it's reverse, right? Because you're selling a put. A put means you want to go up. That means you get long calls or long shares. But if you get assigned on a long put, you get short shares. Okay, just remember that. Okay, very important so that you don't get confused. So with a poor man cover call, why do you call it poor man? Look at this. June 21. I'm going to buy 100 shares or one contract of Apple at $33.65. Just say 33. That's $3,300 at 340. But if I buy 100 contracts, 100 shares of Apple at 340, that's $34,000, right? So think about that. Why did it call poor man? Because it's poor. It's a lot of savings. It reacts similar. Okay, look at this. Look at this delta. 51 delta. Right? You can even go, look guys, 85 delta. Costs you quite a bit, 10,000 bucks. Right? Deep in the money. You just do at the money. If you expect it. If you're afraid that the stock gonna drop, you do a few strikes below. Right? I mean, this is $5,500, better than 34,000 bucks, right? And you just sell calls against it, and that's it. And if you're deep in the money, you want to sell calls out of the money, because you don't want to get this taken away, because you're making money. You're making really good money on this as it goes up. So as Apple goes up, your deep in the money will go up further, so you make more money here. You don't want your leaps to get taken away. So you want to do out of the money. No, not here, but you can do June, right? Each week you can make a couple $100 while you're waiting for Apple to go up and up and up and up. Great income strategies. You're going to make continuous money each week selling calls and buying leaps. Poor man cover calls, a lot of people do this. Okay? But remember, all option decay. When you own stock, there's no decay. So why do I say 6 months or above? Because you want the decay not to start. Because if the price, let's just put it this way. You bought it here at 340. Now the stock is down here, right? Your leaps, you bought it at the money, but now stock dropped to 300. Your 51 delta now becomes even lower. So you got more to climb. That's why poor man cover call. But you with option you do lose money if it doesn't go your way, because the decay, the delta, the theta, everything works against you. So that's why people rather do covered calls, because they know they can own the stock. Okay, so just think of the risk with the Greeks, with the options, and that way you can make your own decision how you want to do it. But as long as that's concerned, if you want to do leaps, you can. But remember, the decay happens if it goes against you, and it can happen quicker, right? So you gotta, if it climb back up, great. If it doesn't, if you keep on dropping, time, theta, and delta works against you in option, not with shares. That's why more people do covered calls than poor man covered calls. Okay, so I know I've video's been 40 minutes now, and I think I've explained pretty much everything for you. As you can see here, again, great income strategies, guys. You can rinse and repeat this every single week. You can do weekly, you can do monthly, doesn't matter how you do it. Just listen. A lot of people do this as an income. They don't trade, day trade. They don't do anything else. They don't guess the market, what Tesla gonna do tomorrow. They buy safe, secure stock. Don't do volatile stock. Do Apple. Let's see, what's a good name that doesn't move too much, that's really safe stock. Disney, a lot of people do Disney. Costco, you can do Costco, because Costco's a great stock to do, but the premium is not that great. Okay, because it's just Costco. They're steady Eddie, what I call it. I do a lot of Caterpillar. I do a lot of DE. What's DE? John Deere equipment. Those are really good ones. Okay, this one, Lockheed Martin. When we have a lot of conflict with China, this pops. and then when you hear good news with China, this drops. So it's a defense, you know. Let's see what else. McDonald's is a good one. Microsoft is a good one. Now is a great one. You can do SPY. A lot of people do SPY and SPXU. You know, you can do SPY. SPXU is the inverse of it. So you can do both. Do about, you know, maybe I can get into another time. A lot of people do, you know, two contracts of SPYs and 200 shares of SPY, and then do like 7 or 8 contracts of SPXU. And so it really, you make money. But I'll get back in that at another time, and you can understand it. I know there are a lot of people that do that. Let's see, UPS is a good one, FedEx is a good one, Walmart's a good one. So again, guys, there's a lot of good names that you can do. Remember, you want a stock to just be steady. Okay, Starbucks, another good one. Let's see. Before, airlines used to be great. I used to play a lot of airlines on that. But now, you know, I used to love LUV, which is Southwest Airline. Love. They're great for covered calls back then. Let's see. Yeah. So again, guys, there's so much names out here to play covered calls. You just gotta know which one to play and do, and just really play smart. Okay. But when you play covered calls, please know one thing. Don't be married to the stock. Okay? Because if it expires, your stock will get called away. Your option will get called away and you're done. Okay? And then you got to redo it again. So don't be married to your stock. You're here to get income. You're here to make an income. That's it. Pure and simple. Okay? Now, you can always roll. If you get tested like this, you're losing money here, you can roll it to the following week. Okay, rolling means simply roll, right? That's it. You roll it to the following week, June 12th now. You can choose different strike, 340. But why you debit 446? Because you lost money right here. Okay? So, again, you can roll it. It's the same thing as selling and buying another one. No difference. But rolling just basically keep you still in the same option with a different strike, and you're gonna try to recuperate what you lost. That's all, basically simple as that. Other than that, that's pretty much it, guys. So videos about it's gonna be about 50 minutes now, so I'm gonna try to wrap up here. I'm gonna recap. Cash secured puts. Remember, selling a put, make sure you have the cash to secure it for 100 shares. That's all it is. Covered calls, we've been over it. You're covering your stock. You buy the call to cover your stock. Covered call. Okay? Or you short the call. You sell the call to cover your stock. That's a covered call. A protective caller, you're just adding a put. If you see, or you're protecting the downside. But remember, long put decays. Long put, you're not gonna win. So I would always do protective caller when you know that the market is turning red. You want to buy a put to protect your caller, or to protect your cover call. Okay, that's all it is. Simple. Poor man covered call is buying a leap, which is a 6 month or more out in expiration, and selling a monthly or a weekly expiration call. Okay, and making money as you go along. Remember, option has a lot of things working against you. Okay, you got the delta, the theta, especially theta. That's the time decay. Remember that. And implied volatility. So say for instance you hop into a stock and because there's a lot of news in it, a lot of buyers and sellers jump in to get into that stock. But when the news is gone, your IV, or your implied volatility, drops, or should I say the demand of that option chain drop. Then you lose more money. So there's a lot of things working against you. Okay, implied volatility is basically an event that drives the price up of the option premium up. Okay, earnings or news or this and that, the premium of the option becomes high and pricey. Just like I said about Costco, their implied volatility is extremely low. Okay, I mean if you can see here, oh sorry, yeah, it's playing. Where are we? Oh, we're after hour. That's why. Let's change this to. That's why it's not popping. Okay, so the implied volatility on an option drives the premium either high or low. So when you have high volatility or high implied volatility, your premium gets stretched out like a balloon. And then when the event or the news or whatever just gone and all the buyers and sellers leave, that balloon pop, and now you have implied volatility is nothing. Look at this, okay? I mean, it's very low. Okay, this is Costco. Right now you can't see it, but usually the closer the expiration, the higher the implied volatility. But if you go out, it's very low. So again, know what you're doing, guys. Understand options. I'm just giving you an example. I do recommend you learn. This is not something that you just jump in and just, blindly go, okay, this is what I'm going to do. A lot of people follow me, but I ask you and I beg you that please understand what you're doing. No, here's the one rule that I always tell you. Know your exit. Know how to exit. Anybody can get into a position, but do you know how to get out of a position? Know your exit before you play that position. That's very simple. If you don't know your exit, how to exit, don't play it. Learn it. Okay? Learn it. Learn how to do it. Practice paper trading on demand, or actually Thinkorswim has paper trading, guys, so you can learn it. Listen, the market is not going anywhere. It will be here long after we're gone, right? It will stay here and it will be here. But if you learn how to do this by either paper trading or by either watching videos on YouTube, what we're doing, VOT is doing for you guys, you can get this and you can learn and understand it. Because I see a lot of people go in and jump in and know nothing. I mean, there are people losing 400,000, 500,000. I've seen it all. Okay, I got many messages asking how they're gonna win this back. Unfortunately, don't ask me to play your money. I won't do that. But again, learn it. That's all I can say. Alright, so you guys have a good night. Enjoy the rest of your weekend. I will post this up hopefully by tomorrow. I'll post this up tonight, and most of you guys will get it by tomorrow. It's already late now. It's midnight here. But anyhow, enjoy the rest of your weekend, and good luck trading.